because there's no straight lines in nature, we are due for at least a pause or at least a pullback. And if we don't pause and pull back from here, then that sets up the potential for a much bigger downturn. I mean, in general, you don't want things to keep going up and up and up and up, because the more it goes up, the harder the drawdown is going to be. And so I actually think it would be healthy for the markets if it had a little bit of a pullback, or calm down a little bit. We'll see what happens. But that's kind of, I'm extra cautious right now, because I think 2025 could be very similar to 2022.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. As we head into a new year, there are a lot of questions swirling about money. Will the dollar strength versus other world currencies continue in 2025? And even if so, will it continue to lose purchasing power versus real things? Will gold continue to be aggressively purchased by the world central banks? How about by investors? And is Bitcoin winning this store of value war? To discuss all these and more, we're fortunate to welcome back to the program CEO and portfolio manager at Santiago Capital, Brent Johnson, the developer of the Dollar Milkshake Theory. Brent, it's great to see you again. Thanks so much for joining us today.
Thanks for having me. Looking forward to doing this. It should be fun.
Should be fun. It was really fun seeing you, Brent, like a week and a half ago in New Orleans. It's always great to spend time with you in person. I got to let folks know who watch you, on the internet here, on these interviews you do with me and other people. You're a tall guy, much taller than I think people appreciate when they see you on camera. So, anyways, but you're also
I'm all legs. So when people see me sitting down, they don't realize I'm tall either. But when I stand up, then they realize it.
And it's funny, you mentioned that to me once, and then we were at a panel. I think it was at the Vancouver Resource Investment Conference. And we sat on the same couch together, and I saw photos of us on the couch. And yeah, torso-wise, I was taller than you on the couch. Yeah. But of course, we stand up, and you got many inches on me. But anyways, tall guy, but also a great guy. I also do want to talk a little bit about the presentation that you gave there at New Orleans, because I think it was a great thought piece, and definitely germane to what we want to talk about here. So maybe we can get to that in a little bit. But to kick things off, Brent, let me just start with a question I like to ask you at the beginning of these discussions. What's your current assessment of the global economy and financial markets?
Well, I mean, I think you got to say euphoric, don't you? I mean, everything's at its high. I mean, Bitcoin's at its all-time high. Gold's within $100 of its $150 of its all-time high. Stock markets are all at their all-time high. The VIX is at its low. So I don't know how you could give it any rating other than euphoric at this point.
Hey, I'm sorry to interrupt you.
Which worries me, right?
Yeah, and I'm sorry to interrupt you, but just because you use that word euphoric, I literally just sent this chart around on Twitter or X earlier today. I didn't even know this thing existed, the euphoria meter. And I guess it's an index put together of forward PEs, the VIX, and bullish sentiment. But you'll see here, this chart goes back, I think, a little bit over 30 years. And the euphoria meter has never been higher. So yeah, if you're feeling euphoric, you got a lot of company.
Well, it's funny because I'm not feeling euphoric, but I think everybody else is. Whenever, it's funny, I think everybody kind of intuitively knows this, but it's kind of hard to do it. Is that, when everybody's depressed is when you should get a little bit excited, and when everybody's euphoric, you should start getting a little worried. And it took me a really, really long time to kind of figure that all out. But everybody else's euphoria is starting to worry me a little bit.
Okay. Well, obviously that's a riff on Buffett, right? Be greedy when others are fearful, and vice versa. All right. Well, okay. I'm going to give away a little bit of the punchline here. Before we got on camera, you mentioned to me that you literally, I think, just changed some of your positioning in your portfolio because of the extreme level of euphoria you see here. You're nodding briefly as I'm saying this. Let's hold off talking about that for a second, just because I want to get back to the original question. Beyond just everyone's euphoric, I'm not, in terms of the global economy right now, how do you assess it? How are you looking at it? What's got your attention?
Well, I mean, what's really got my attention is Trump, right? I mean, him coming into office in January, it's already affecting everything, but it will, it'll amplify that in January. And what really has my attention, kind of going, it's kind of related to both things we've been talking about, is that, when you have, there's a couple of things. Asset prices are in general at their all-time highs, specifically equity markets. Even Germany, whose economy is slowing and they have got all kinds of problems over in Europe, the DAX is I think at its all-time high. And so that paired with a VIX within at least spitting distance of its all-time low, or not all-time low, but recent low, that gives me pause. And the thing that I think is really unique about it is that the dollar is not at its high, but it's the highest it's been in a couple of years, and yet the VIX has remained steadily low. And I think I understand why that's happening that way. I just don't think it lasts. In other words, when you get these kind of extreme readings on things, you are typically going to at least get some kind of a pause or a correction. Now, it doesn't mean you're going to have a crash. It doesn't mean the Great Depression is right around the corner. It just means that to continue on in that rate and that speed is highly unlikely. And when I look around at all the indicators I look at, everything's kind of at an extreme right now. And so that gives me pause. And I think why that's important is, and I know we don't need to make this whole thing about the dollar, but the dollar is something that I look at. And the whole reason I even kind of came up with the whole dollar milkshake theory in the first place is because if you don't understand the dollar, it's really hard to understand what's going to happen in the global economy, or at least what could happen in the global economy. And we're at a point now where I think if it goes much higher, it starts to break things. It had fallen pretty precipitously into, the August, September timeframe, mainly on the expectations for the rate cuts, right?
Mm-hmm.
And then, of course, like many things, once the rate cuts finally arrived, it was kind of a sell the news, or in this case, a buy the news event, because it was already all priced in. And as soon as they cut, I think the DXY kind of stayed flat. Maybe it went down over the next 4 to 5 days after that first cut, but then it's just been up ever since. And typically, if you had and I think it went from like 102 to 108 or something like that. That's a pretty big move for a currency.
Yeah.
I think the reason it didn't quote unquote break anything is because it was just very steady, and it didn't rocket up, right? And so I've always said that as long as the dollar kind of stays within a band, the global economy can, for the most part, handle it. It's when it moves really fast or really unexpectedly. But if it gets to a certain level, that's when, even though it's going steadily, the pressure is just too much and things start to break.
The dollar
And
is
I
just
think
too damn high.
it's just too damn high, right? And so that's kind of where we're at. Like I think if the dollar goes much higher, we're going to have some problems. And when you look, typically when the dollar's at its high like this, you would expect to see the VIX higher, because as the dollar goes higher, it typically causes problems. So for me, when I look at the combination of the S&P, or equities, the VIX and the dollar, it's kind of explained by capital flowing into the United States, the rest of the world wanting to own U.S. assets, especially post Trump's election. Now that said, it probably, it's not going to continue in a straight line. There will be pullbacks and corrections, and then that's what has me concerned, because you never know whether it's going to be a 1 or 2 day pullback, a 1 or 2 week pullback, or something more significant than that.
Okay, and I wanted to preface the intro, which I didn't, and I'll do now, is I do want to get into all your expertise around the dollar and all that and everything I mentioned in the intro, but I do want to try to make sure that we talk to Brent Johnson, the capital manager, as well as just the Dollar Milkshake Theory developer.
Sure.
And so you've got to, given your macro outlook and your views on the market, you've got to figure out how to be positioned, for now and for what you see might be coming. If I can, let me ask you a number of questions here to kind of flesh out what you said. So you said you're concerned because, asset prices are at all-time highs pretty much around the world. Don't let me put words in your mouth. My guess is you don't care so much about the specific price that things are at. You care more about the levels of valuations, right? In other words, these prices relative to forward PEs or, other benchmarks, that you talk, you're more worried the fact that we're at extremes, right? Extremes of valuation, and they're called extremes for a reason, right? Because they revert, right? So sounds like you're a bit worried that, okay, the rubber band is pulled far enough that at some point here we're going to get some sort of snapback.
Well, and I think it's all in general, there's nothing wrong with high prices, especially in asset. I mean, you should want that, right? So in and of itself, there's nothing wrong with stock markets or equity markets or asset prices being at their all-time highs. In general, that's what we want. What worries me a little bit is the speed with which it has happened. I mean, I think equity markets are up between 5 and 10% since the election. And I think, and the dollar has risen since the election, but I don't think people quite understand what Trump's policies mean for asset prices and currency prices and, all of the stuff that then goes into, a portfolio.
Okay. And my next question was that,
Yeah.
so take it right there.
Okay. Well, so look, if I step, and here's the thing, I'm going to preface this because I've had a couple of people tell me, Brent, whenever we hear you talk, you're always talking about the dangers out there. You're never saying, hey, this is a great time to buy this, or, this is something that we think is going to break out, or you're always talking about the dangers. And here is the reason. For the most part, if you look at history and you study history, you understand that asset prices tend to go up and to the right. And they go up and to the right over long periods of time because, humanity gets more innovative, they get more productive. We have more people in the world, which creates more demand. And so, more demand pushes the asset prices higher. And then you also have this, thing called fiat currency. You have this thing called fiat currency, which tends to lose value over long periods of time. And, so you don't just want to be sitting in nothing. You want to be sitting in assets so that it's protected against the debasement of that fiat currency. And so my clients and the assets that I manage, we're long assets. We're always long assets. And so if things continue up and to the right, we're going to make money and we're going to be fine. So what I spend a lot of my time doing is how do we protect against the rogue wave? Mm-hmm. And how do, when markets are at their all-time highs, prudence is not usually a popular word, right?
Right. And sorry to interject, but in your answer, is it just the rogue wave, or is it also how do we protect against the natural down cycle?
Well, it's both. It's both, right? It's both. I mean, the one thing that you realize, and I'm looking at your background there, you've got wood and you've got some kind of plants. It reminds me of nature. But there are no straight lines in nature, right? And there are no straight lines in markets. Markets don't go in a straight line. They move and they weave and they surge and they pull back. And so, I think when people extrapolate a hard move like we've seen either year to date or the last 6 weeks and think that just automatically will happen, I've been around long enough to know that isn't the case. And so I'm always looking for, is this a time to be more careful? Is this a time to be more risky? And probably you can tell from what we've talked about so far, I think this is the time to be more careful. And so you mentioned our conversation before we started today. What I would tell people is I don't have like a super sophisticated quant model that, analyzes every single thing in the world and automatically tells me what to do. What I have done over the 25 years of doing this now is build, a handful to a dozen different indicators that I look at on a regular basis. And when those indicators get into extreme territory, either extremely low or extremely high, then I start to either dial back or I start to put more positions on, depending on where we're at. Now, with everything at their highs, then, I'm obviously looking to pare things back. If we were at their all-time lows, or if we were pushing a low, then it would be different. But over the summer, in June, I believe it was, we were heading in, I think we had the Fed meeting and asset prices were getting very extreme. All the indicators I look at were getting very extreme. And we started to buy some hedges. And then what happened was the market surged even more. So, between the third week of June and the middle of July, those hedges that we had put on, they started to hurt, to be quite honest. And you're like, wow, we didn't get that right. But then there was a day in July where literally every one of my indicators, and this is the day that everything was at its high. Every single indicator I looked at was like flashing red. You sell, hedge, get out, whatever, right? And in 25 years of doing this, that had never happened before. And we actually doubled down on our hedges, and we had a very good second half of July and first part of August when the yen carry trade kind of reared its head and we had the volatility spike. So that worked out really well. And I remember thinking kind of in mid-August, I've been doing this for 25 years. I've never seen that before. I'm glad that the system worked. And then I remember also thinking I could probably do this job another 25 years and never see it again. And we didn't quite get there right now, but we are very, very close. And so it's kind of amazing to me that, I've been doing this for a pretty long time now. I'd never seen it happen before until, over the summer. And now it's very close to happening again if we're not there already. So that gives me pause. And that tells me, because there's no straight lines in nature, we are due for at least a pause or at least a pullback. And if we don't pause and pull back from here, then that sets up the potential for a much bigger downturn. I mean, in general, you don't want things to keep going up and up and up and up, because the more it goes up, the harder the drawdown is going to be.
Mm-hmm.
And so I actually think it would be healthy for the markets if it had a little bit of a pullback or calm down a little bit. We'll see what happens, but that's kind of I'm extra cautious right now.
Okay, so you're extra cautious right now. It sounds again like that is because of market conditions. And that's, I mean, when you're managing capital, you got to trade the market you have, not the market you think you should have or wish you had, the market that's right there in front of you, right? And that's where your indicators become so important. I want to get to your sort of thoughts on where you think the dollar is going to go and what you think that impact that's going to have, on the system. And you already kind of tipped your hat to this earlier, that if it goes much higher, you think it's going to start breaking things. But on the more macro side, right, the more sort of like trends that you think will drive the action in the economy and thereby derivatively in the markets in the next year or so as we enter a new year here, what are the things you're looking at? Now, you mentioned Trump, right? So obviously Trump's got some animal spirits going on in the markets, and that's probably a big contributor what's been happening in the markets in the short term. But are there any parts about his economic plan right now, or the people he's putting in place, that you think change the game in material ways? And in your answer, if you can, I'm going to ask you a question that I've been asking a number of people on this channel recently, and I'd love to get your thoughts on it, which is, let's give him the benefit of the doubt. Let's say that he accomplishes some of the main goals that he's set for himself economically. We're going to gut, government bloat. We're going to deport millions of illegals here in the country, many of whom are working in the economy but under the table. We're going to use tariffs, or at least the threat of tariffs, to negotiate better trade deals for America. Assuming for a moment he's successful in having those in place by the end of his 4 years, can we get from here to there without some pretty material disruption in the economy along the way as the Band-Aid gets ripped off with a lot of those things?
I don't think so. And that's kind of what that's a big reason of why I'm cautious right now. Even if we weren't at the extreme readings on the different signals that I'm looking at, I would be cautious. And I really kind of think that we're setting up for another 3 or 4 years, just like the last 3 or 4 years. And what I mean by that is I think 2025 could be very similar to 2022. If you remember the first, 6 to 8 months of 2022 were pretty volatile, some pretty significant downside in risk assets. The dollar was rising, obviously, as they were hiking rates. And, it was a very uncertain time because people were uncertain how much further is the Fed going to hike, right? And so this time around, We don't really have the threat of the Fed hiking, although they may not end up cutting as much as many people want them to.
Yep.
But we do have the uncertainty of what the hell is Trump going to do, right? And we already know some of the stuff he's going to do. I think there are some people who are thinking / hoping that he kind of does what he did last time, and that he does the Trump things, but he does them in a slower manner than he has promised to do them. I actually don't think that's going to happen. I actually think that he is going to go 100 miles an hour. And I think, and the reason I keep saying I think is because I'm not married to any of this stuff. I want to say that, like, I reserve the right to change my mind, but I think Trump's plans have a better chance of working if he goes 100 miles an hour than if he tries to go slow. And the example that I will use is Javier Milei in Argentina.
Mm-hmm.
Now, they don't have the exact same, economic plans, and they don't see the world exactly the same way, but they do see things similarly. They're both populists. They both, say we need a change. The historical policies are not working. They're skeptical of the central bank, all of this stuff. And so when Javier Milei, who's, if I didn't say it, he's the president of Argentina, when he was elected, I think a lot of people said, well, he got elected on running on this crazy platform, but he's never going to actually do it. Well, he has by and large done everything that he said he would do. And he's going 100 miles an hour.
Except peg Argentina to the US dollar. But yes, otherwise,
right,
yes.
Right. And they have had some success. It doesn't mean that everything is fixed. It doesn't mean it's perfect. It doesn't mean there's not going to be some, hard times ahead. But I think part of the reason he is having success is nobody can catch him. I'm using that kind of euphemistically, but I feel like if he pauses, they're going to eat him alive. And I kind of feel like it's the same thing with Trump. Trump has got a lot of momentum. He's got his mandate. All you have, regardless of what you think about Trump, all you have to do is pull up the map of the election that shows the winner by county.
Yeah.
And it is just a sea of red. The guy has a mandate, right? Whether you like what he is about or whether you hate what he's about, he won the election. He has a mandate, and I don't see him stepping away from it. But the things that he's going to do, it's like anything. The things that you need to do to make things better in the long term or medium term often hurt in the short term. And, Trump doesn't have a magic wand that he can wave to make some of those hard things up front hurt. The reality is that to take a system like we have now, where we don't have tariffs, where we largely embrace free markets, and I know we don't really have free markets, but more free markets than anywhere else. And you have a system where government spending is a huge percentage of GDP. And now you come in and you say, well, we're not going to do trade deals the way we used to anymore. And you say, we're going to cut government spending. Those two things in and of itself have the potential to cause a lot of problems. Mm-hmm. Now, it doesn't mean it's not the right decision. It doesn't mean that it can't work long-term. And in fact, I actually think there's many people out there, whenever you bring up the word tariff, they automatically think it's not going to work. They automatically think it's going to boomerang back on the United States and hurt us while it doesn't hurt the rest of the world. They will automatically go to Smoot-Hawley and say, look what happened the last time we did this. I think I understand the points, but I think people are too quick to jump to those conclusions. Somebody that you interviewed a week or so ago, who's become a pretty good friend of mine, Michael Every, I think does as good a job of anybody as laying out kind of the grand strategy of all this and the way that you can use these economic policies as part of overall, statecraft. And I think that's largely what's going to happen. And I think the people that automatically write off the United States and automatically give victory to China or Russia or whoever our trading partners are, I think you might need to think about things a little bit closer than that. Now, this is why I say I think the first 6 to 9 months could be pretty tough. But I think if they really kind of go forward with what they're talking about, we could set up to where, the following year and the next 2 or 3 years, we could have a real boom, for lack of a better word. And I don't, it is not a guarantee. I don't know for sure that's going to happen, but I can see how it can happen. And so I'm not a perma bear. I want to make it very clear. I think asset prices are actually going to go a lot higher. But where we are now in the cycle, where we are now with the readings, and where we are now with Trump just coming in, I think it bodes for caution.
Okay. Couple of things. One, so Michael Every, I agree. And I was actually there when you guys met in person for the first time and
Yeah.
got to see that relationship bloom from day one. But Michael's a great guy. I've been interviewing him for many years, and he, to his credit, for a long time has been predicting that the world will shift away from the unipolar globalization model and more towards what has existed for pretty much most of the rest of history besides the past couple of decades, which has been this more mercantilist approach. And folks, if you have not yet watched one of my interviews with Michael, where he really lays out, exactly the framework and how he sees it and the rationale for it and what he, thinks it means for the future, highly recommend you go watch the last one I did with him. It's still relatively recent. I think maybe only about a month old or so ago, but you can find that video easily on his channel. Secondly, your thoughts about the swifter Trump moves, the more likely to succeed he'll be, and also that if he's able to implement these reforms to the extent he wants to, that it could set up a real boom. Somebody who agrees with you wholeheartedly on both accounts is Art Laffer, who has been an economic consultant to presidents, I think, since like the Ford era, and was definitely advising Reagan during the Reagan era, and pre-Trump thought Reagan kind of had the best playbook. And he said he's even more excited at the playbook that Trump is likely to run, at least as well as Laffer knows it right now, and says if Trump can move fast, he thinks it will unleash a big boom, and also says the markets could have a great 5 to 7 years ahead of them. So anyways, other people have different opinions, but certainly that's a guy that's been in the economic policy mix for many decades who's very, very excited about this. Okay, so I guess let's go to, well, actually, one question around this, and we're just discussing this in real time, and we're not political analysts per se, but something that has been, I think, a big factor in driving the economy and asset prices substantially over the past 2 years has been liquidity. Right, so you talk to guys like Michael Howe who really focus on liquidity, and they basically say it's all about liquidity, and that's Michael's one Uber indicator, right? That's what made him become bearish in October of 2022 when everybody thought we were going into recession, right?
He became bullish. He became bullish in October.
He became bullish. He bucked the trend, and he's been bullish since, and he's been proven right. And my last interview with him, which was not that long ago, probably within the month, he said, "Hey, look, these liquidities waves travel in cycles, and they're multi-year, and 2025 will still be a year of increasing liquidity, but the impulse of the liquidity wanes, right? It's like throwing a ball up in the air, right?" And he said, "Look, I'm concerned about 2025. I think it's going to be a disappointing year for investors, or a rougher year for investors. Still might be an up year, but everybody's used to these 20% plus annual returns now, right? So even a year of single-digit percentages are likely to be disappointing to them." He's also very worried about the corporate debt refinancing wall, which really is starting in earnest next year. He sees that as acting as a big liquidity sponge, pulling stuff out, and then of course his model the liquidity starts contracting in 2026. So he's like, "I think it's going to be terrible in 2026, but let me come back on before then when I have more data to really let you know for sure." But that's kind of all-in measures of liquidity. A big factor of that obviously has been the amount of liquidity that's been directed in the system from the current administration, which is now departing, right? So when you've got Trump coming in, Doge is a big part of the equation. We're going to try to cut wasteful spending and all that stuff. Do you see a decrease and of course there are certain programs of the current administrations that Trump wants to dismantle, spending programs. So do you see a reduction in potentially the deficit coming up and reducing some of that liquidity and removing some of the what's been propping up asset prices? Or will Trump simply just take that money and funnel it to things that he says are much more essential?
I think it's much more likely to be the latter than the former.
Okay.
I have a hard time believing that the budget deficit's going to fall or the national debt is going to fall. And if it does fall, then we are going to have a tougher economic time than I have so far discussed.
Forecasted. Okay.
Forecasted. Now, so you have to be ready for that. I mean, again, I think all of these things are on the table. But the idea, I mean, listen, Trump's a deal maker. But you know, he wants to take the waste and he wants to give it to somebody else, and he doesn't want mass unemployment and he doesn't want a recession. So, you know, I think the idea that he's just going to come in and cut everything and not try to do other things to push the economy forward would be, at least in my opinion, a little naive. But I do think he's going to move forward on that. I do think that Doge is going to cut some stuff, and I do think that, you know, there will be waste cut. Now, is it going to be completely cut? Of course not. And is some of the new spending that they funnel it to going to be wasteful in itself? Probably. I mean, it is still
Right.
going to be government after all, right?
And sorry to interrupt, but so
Yeah.
you're looking at Doge as more of a redirection, right? Which is we're cutting wasteful government spending, but rather than just not spending the dollars, we're just going to redirect those dollars to something we think is
Well,
more efficient.
they may cut some, right? They may fully cut some, but I think a lot of it will get redirected in other places.
Okay.
That would be my guess. We'll have to wait and see, but that would be my guess.
Okay. We're getting a little far afield here, but I'm curious to ask this question for you. So we are currently deficit spending at levels that we haven't seen in this country, except in very few times in our history, usually when we've been in a world war, right? I'm kind of with you. I don't see the next administration really moving the needle downward much at all in terms of deficit spending. Are we just in a new era now where the new normal for deficits is what used to be crisis levels? And if so, what's the trade-off for that?
Well, I have an answer, but it's probably going to come back to something you don't want to talk about, is the whole dollar milkshake theory.
Oh, it's something I want to talk about. No, actually, I'm kind of going to the dollar next.
Yeah,
so
well,
great.
the funny thing is that you know, I even get tired of talking about it sometimes, but I do, but I think it's right, so I end up talking about it. So I think we're kind of in a new era, and I don't want to say it's different this time, because it's literally never different this time. But the point that I have tried to make over the last several years is that because of all the debt in the world, and because it's not just in the United States, that we're at a point where governments and monetary authorities are somewhat limited in what they can do. And so in many ways, they will be reactionary agencies as opposed to proactive agencies. And I think the debt dynamics of the world will, for lack of a better way of saying it, force governments to continue doing what they're doing. And I think the byproduct of that is that the US outperforms the rest of the world for all the reasons that we've outperformed the world for the last 2 or 3, 4 or 5 years. You know, there's a number of those charts going around that show the US outperforming the rest of the world at an all-time high. And again, it won't be a straight line, but I expect that to continue. I think over the next 4 or 5 years, that continues. And that is why I don't want to say that debt doesn't matter. My whole premise is based on debt actually matter, that it does matter. It's just that it will matter elsewhere before it matters here, in the US. And that then kicks off a whole chain of events that in many ways exacerbates the situation that we're already seeing. I mean, this is part of the reason that stock prices, that Bitcoin, that gold, this is part of the reason that prices are where they are, is because there is still liquidity in the world, but it's all flowing into the United States.
Which, of course,
it's,
you have been predicting
right?
With your theory. I mean, that is what your theory has been predicting for years. Yeah.
Yeah, and that's the thing. Like, I think a lot of people think that the dollar milkshake theory is just the dollar going higher, and that's just the catalyst for everything. I named it that because the dollar is the catalyst for to the entire global economy. But the knock-on effects of the dollar going higher is the US outperforming the rest of the world. And that's largely what we've seen. Now,
Right. It's really the world's capital comes to the US theory, right?
right. No, exactly. That's exactly right.
Yeah. Okay. So we talked about your presentation that you gave at New Orleans, and I think this is a good time to bring it up here. So um, I'll let you really explain it to
Yeah.
people, but what I took away from it was it was a thought piece to kind of challenge our thinking, and it certainly, got me thinking. And you basically said, what is money? Let's try to really figure what money is. And you went through a bunch of traditional explanations, and you said, just bear with me for a moment. What if money is power, right? Like, what if money is whatever power decides is the currency of the realm at any given time, right? And you use the example of the thug, the prison thug, right? Who wanted cigarettes, but now wants sardines, right?
Yeah.
And both can be used as effective currencies inside the prison system, but one may be in favor one day and then out of favor tomorrow, and it's because the thug has decreed by fiat what he cares about. And there's nothing you can do as long as you're not big enough to displace the thug, right? His word is law, essentially. And of course, you then related that to countries and whatnot. And of course, the takeaway there is we hear it called the ugliest or the best looking horse in the glue factory, or the cleanest shirt in the dirty hamper, or whatever, right? But the US is still, for the most part, the biggest thug on the prison block, and geopolitically speaking. And this, I believe, is sort of one of the reasons why you think, all right, so what? We've raised our deficit spending from an average of 4% to 9% of GDP, or whatever it is, right? What are the rest of you going to do? We're the world's reserve currency. You're all dependent on us. Sorry, you don't like it.
And it's kind of a combination of a couple things. Not only are we the biggest thug on the block, but we're also the cleanest dirty shirt in the hamper, right? So we've kind of got two things going for us, whereas many other places don't even have one. And listen, this is not me being the American exceptionalist. This is not me thinking the United States is the greatest place in the world and everybody else is a dump. That's not it at all. This is really trying to just stand back and just be hyper objective about it all, right? And just and the thing is if you talk to people that live in other countries about this, they get it much quicker than when I talk to Americans.
Right. Yeah.
Because they're used to thinking in two different currencies. They've saved in dollars their whole lives. They've invested their excess savings into the United States, so they kind of get it. But the whole point, the point of the conference, or the presentation I gave at the conference, was not so much for me to say this is money and this isn't. It was really just to get people to think about things, because I feel like we're in a world where sides are always being chosen. You're either a gold guy, or you're a Bitcoin guy, or you're a fiat guy, or you hate gold, or you love MMT, or you hate MMT. And the point that I wanted to get across was, if you're managing your portfolio, you have to remove dogma and you have to remove fundamentalist beliefs. In my opinion, you're going to be better off if you can remove these fundamentalist beliefs and kind of be a little bit flexible. And I talked about situational awareness, right? And the example I'll use is MMT has become this thing over the last, call it, I don't know, 5 or 10 years, where it just immediately triggers people. And if they figure out that that's kind of what you're talking about, they just immediately shut down. They say it can't possibly work and it's going to end in disaster. And my point is, well, yeah, you might be right. And maybe it will end disaster, but it might not end for another 50 years. And in the meantime, you have to manage your portfolio, right? Mm-hmm. So have some situational awareness and understand how money in their system works, as well as understanding how money in a free market would work. And because sometimes it's one, sometimes it's the other, sometimes it's both at the same time. But I really think the next 5 to 10 years are going to be incredibly opportunistically, but incredibly challenging. But I think if you wake up every morning shouting at the clouds saying fiat is not really money, or that we should be on a Bitcoin standard, I think or, I hate the dollar, or I love gold. It's fine to have those feelings, and it's fine to, have your preferences. But I think the people that get stuck into a fundamental belief that this is the only way it can and should be will have a hard time navigating the markets ahead.
All right. Which I think, was I think the objective of your whole presentation there was to shake people out of their dogmatic positions and just say,
Yeah.
for a moment, look at the world a little bit differently with me. All right. Well, look, I've got a couple questions related to that, but let's try to wrap the dollar into it. So, as you look out for the next year, let's just look going into 2025.
Yeah.
And under the Trump administration, what is your outlook for the dollar? Because I guess I would say, listening to you, well, you'd expect it to go higher because of the theory and, perhaps because of some of these other policies that Trump has mentioned. But at the same time, you also said, but if it goes much higher, it's going to start breaking things, which then likely will bring it down. So what kind of, are you just looking at for a more volatile year, or what are you looking for in terms of the dollar's performance next
Yeah,
year?
my
We're
guess
talking
is that
about we're talking about versus other fiat currencies.
yeah, my guess, I mean, this is just pure guess at this point, but my guess is that the dollar probably stays fairly strong into the first quarter, and that probably causes some problems. It hasn't really caused any problems yet, but it will probably start causing some problems by, February, March, April timeframe. And then I would expect the Fed or the monetary authorities or Trump's Treasury Secretary, or, just him getting up there on the bully pulpit and saying something, put something in place to kind of maybe relieve a little bit of that pressure. And so maybe it pulls back a little bit. But then, as we move forward in time and, some of his policies get put in place, I actually think we're going to get into a situation where the dollar will rise. It will be very similar to what we've seen for the last 2 or 3 months, where the dollar rises, but it doesn't blow things up in the United States necessarily. Where I worry more is outside the United States.
Right.
I think China, I think Japan, and I mean literally everywhere. I actually have more hope for South America probably than I do Europe, China, or Japan, and including Russia, because they just have so many problems, and they do not have the advantages that the United States has. I'm not saying the United States doesn't have problems. We have incredible problems, but we just have so many advantages that the rest of the world doesn't. And the big one is that we have the dollar.
Yeah. Okay, and I want to get to the BRICS briefly for a second. And I'm sure you know why. But just walk me through for a moment. The rest of the world does feel the pain a lot more than we do, right? And there's some sort of cascading trouble across the rest of the world. How does that play out according to your theory's playbook? I would assume as countries struggle, initially capital is fleeing to the US. And so the US's relative position gets even better versus them as they're sinking and we're still, getting levitated by capital flying here. But eventually, presumably, the rest of the world could get to a state where the contagion then begins to impact the US, correct?
Oh, absolutely. No question. And again, I think 2022 is a very good example. The first half of 2022 wasn't pretty for the United States. But if you remember in 2022, China's real estate market and stock market started its precipitous crash. Japan had to bail out both of the yen market and the JGB market. The Bank of England had to bail out the gilt market. Italy's bonds started doing what France's bonds are doing right now. And so the ECB set up a special facility to buy those. And the U.S. extended swap lines, and so what I think is going to be different now in the years ahead, especially with Trump back in the White House, is I don't think the swap lines or the bailouts for overseas entities that need dollars are going to be as free flowing as they used to be. I think there will definitely be strings attached. I have a hard time believing that Trump would happily sit by and watch a swap line get extended to France so they can bail out Airbus while jobs are being lost at Boeing, as an example, right?
Mm-hmm.
He would probably say, no. France, you can have we'll loan you some dollars, but you can't give it to Airbus. Those dollars are being used for Boeing. And that's just a simple example, but I think that's the case. I think, and this gets back into what Michael Every has talked about. This is statecraft in addition to economic policy.
Right. And for folks that have yet to see the Every discussions, what he means by that is sort of layering the priorities of the state over natural economic forces. So, for example, he would say, look, governments will increasingly feed parts of their economy and starve other parts of their economy because of a policy goal, going forward, a geopolitical policy goal. And so it's just not going to be left up to the free market, more or less. Like in the past, when there's been a bailout, they would try to kind of bail out everybody. It's much more likely to be a lot more selective going forward. Okay, no, these are the strategically important industries. These ones we're going to let suffer. Yeah.
Right.
Okay. I'm just going to ask this question before I move on. There were a lot of people that expected a recession coming out of 2022. We never got one. There's certainly a lot of people that can, and many come on this program and do, make the case for why they don't think one is avoidable. And at some point, obviously at some point we're going to have a recession, but that, we're not going to be able to avoid one for too much longer. Do you have any sort of dog in that fight?
Well, again, I'm going to sound like a broken record here, but I think in 2022, technically, by the old definition, I think we did have a recession, but some people called it not a recession because it recovered pretty quickly, and there was, they maneuvered some of the statistics a little bit. But what is the definition of a recession? 2 quarters in a row of negative GDP growth, or something like that.
Yeah.
And so I think we could have something very similar, where maybe it's a kind of on the edge of recession, but I am not in the camp that says we're going to have a massive recession. That's not my base case. I am much more in the, we're going to have some tough times and asset prices might suffer. But I think that, not too far down the road, things will happen that will then, lead us out of it.
Okay. Well, let me just ask you this. So, I've posited a couple of times in the past, before we knew who was going to win the election, or that I can make a pretty good argument that whoever won had an incentive to kind of let the froth clear out of the system early on in their first year, right? Now Trump, at least looking at his 2016 playbook, he wants the S&P to basically be the barometer of how well his administration's doing. Maybe he'll just continue that. But what do you think about kind of the logic that, hey, he's got some runway to do his disruption, break things, and let a lot of the froth in the system clear out, and just blame it on the Biden administration for the first year or two, and set the bar low so that however things look in year 3 and year 4 look great relatively?
Yeah, I think that's very possible. If I can't, if we do have disruption and problems in the first half of the year, I can't imagine that he's not going to blame Biden for it. And he can also, whether he will do this or not, that's a good question, but he can also say, listen, we are changing 30 to 40 years of the way we've done things. I am in the process of bringing your wages back home and trying to bring some of the manufacturing back home. That can't happen without some disruption in the short term. And so, that's what's happening now, but stick with me. This is where we're going.
So is he making an error, in your opinion, by not starting that messaging now?
It's easy for me to say, yes, he's making that mistake, but you got to remember, like Trump's a promoter, right? I mean, that's who he is. And he's like, we're going to win, we're going to win, we're going to win. You're going to get so sick of winning. Right. And the reality is there is something to that. There is something to being a promoter. I mean, people have talked about this since the election, that there is a change in mood in the United States, right? Sure. It's okay to be an American again.
It's very much like the 80s. It is very much
right.
Like
and so, I think he, in some ways, if he were to tampen that animal spirit down, that might hurt the chances of him being successful, right? I think there's probably a middle ground there, and Trump's not one for middle ground, right?
Yeah.
He'll just say whenever everything is good, is up to is due to me, and everything that's bad is due to Biden. So that's what I would expect him to keep doing. So, Trump would be one of those guys I would never try to give advice to because he would never listen.
He'd
He's
never
going to
take it.
do
Yeah.
he's going to do what he's going to do, and you just need to react to it.
Yeah. I guess where I was going with the question is the playbook, the central planner playbook, obviously is, hey, any issues, anyone's feeling pain, we step in and we provide succor right through our stimulus. Could Trump be less likely to do that in the first year of his administration because let's let the bloodletting happen? Like, let's get this stuff away. I can still blame it on Biden, and it sets me up for a lot more success in my later years.
Well, he could. The question would be, I don't think he would do that unless he listens to his advisors. Perhaps the Treasury Secretary, who's a markets guy and understands these things, could prevail upon him to do that. But my guess is that the minute things start to go south, he's going to be, on CNBC saying, "Why isn't Powell cutting rates yet? I'm going to have to put somebody new in there. I think I should have a seat on the Fed board." I mean, it's hard. It's hard for me to see him not doing that.
Doing that. Okay. All right. Sorry to make you prognosticate about
That's all right.
Politics, but I value your opinion and it is fun. All right. The question about the BRICS, and we'll keep this super quick because I know you get the question all the time. But what about the competing BRICS currency, and isn't that going to dislodge the dollar? And you've had plenty of conversations about this where you basically said highly unlikely for a whole bunch of reasons. One of the reasons that you've said is the U.S. has a deep bag of hardball measures that it could bring to bear. World's largest military is just one example, right? That it hasn't even begun to deploy yet in this fight. And then just last week, we had the announcement from Trump to the BRICS countries saying, "Hey, I want you all to bend the knee and kiss the ring right now and promise me that you're not going to try to create a competing currency. Else I'm going to slap 100% tariff on your goods," or whatever the threat was. So is that a classic example of what you were warning about?
This is a perfect example of Trump. And here's the thing: is some people said, "Oh, this makes him look weak. He never should have brought it up." It doesn't. I don't think it makes him look weak, because here's the thing. Number one, he didn't need to say it because there's nothing the BRICS can do to unseat the dollar. I mean, I've been over this a million times. We don't have time to go over it in detail now.
Agreed.
But what Trump is doing is he is anchoring all future conversations at an extreme level. And, and by the way, that's what he's done with our two biggest trading partners, Canada and Mexico, right?
And it's classic deal negotiating 101, and he's lived it his whole life. Yeah,
exactly. And whether you think of him this way or not, he thinks of himself as the ultimate deal maker, and he's the ultimate negotiator. But he's going to try to get the best into the deal. And so he knows the power that the United States has. He knows the economic power that the U.S. has by keeping other people out of our markets. And so he's basically saying, if you don't play ball with us, you are not going to have access to the United States markets, right? And he threatened putting tariffs on Canada and Mexico, which we have a free trade agreement with, right? and if we don't stop if we don't close the border, and what happens within a couple days, he's had a great phone call with the president of Mexico, and Trudeau flies down from Canada to meet with him, and so it's just classic Trump. And for the people that think that Trump is a buffoon and kind of a jackass and this blowhard, maybe there's some truth to that, but he also kind of knows what he's doing. And he's not totally wrong in this area, right? The rest of the world does want access to United States markets. We are the global demand for goods. And you can see it already with the way people are reacting to his threats. And so and not only that, it's like, Trump is kind of this crazy guy that keeps everybody off balance. And if you're on balance and everybody else is off balance, it makes it easier to negotiate. So I would expect him to continue to try to keep people off balance.
Okay. Last part on the BRICS is a question that I've asked a lot, and I know I've asked you in the past, and I believe you agree, is, are people giving the BRICS coalition more credit for a it's sustained potential solidarity, where the U.S. and its Western alliances, these have been in place, and these relationships have been in place and favorable in certain cases for more than a centuries even, where a lot of the countries in this BRICS coalition have had very checkered relations in the past, some of which are still actively skirmishing on their borders, right?
Yeah.
And when I was talking to Michael Every about his view of the world, he said, the future, asked him if the future is going to be, more like Star Trek or Star Wars. And he said, oh, absolutely, it's going to be more like Star Wars, right? Meaning it's not everybody working together to this,
Yeah.
universal globalist type future. It's going to be every planet for itself, basically. And so with that Star Wars analogy, I was like, yeah, it's kind of like, if the U.S. empire is the big thug, right? If the U.S. is the empire in Star Wars, right?
Yep.
Heavy-handed, kind of everywhere, right? Calls the tune. Is this BRICS coalition more like the Federation, the Republic? Like the rebels that are trying to take down the empire, or is it more like the Mos Eisley Cantina, where it's just this kind of like rogues gallery of
I think Mos Eisley is the perfect example. Yeah, I think it's more like that. And again, this doesn't mean that the BRICS countries are not important, powerful countries. They are. China is a very powerful, important country. Russia is a very powerful, important country. Same with Brazil and India. But just the idea that just because they get together and meet at a hotel a couple times a year, that they're all of a sudden going to launch this currency that's going to displace the dollar, it's when you actually really think about it, it's really silly, in my opinion. The people that are predicting this, I don't think that they are serious people who have actually thought it through. It's kind of one of those things that they want it to be true, but when you actually understand what it takes to be a worldwide currency, it's just not there. And I actually believe if it really came down to it, the Brazil, we could break Brazil off from the BRICS. Sure. And I actually think, as the world becomes more regionalized and fractionalized, I think we're going to see a Monroe Doctrine on steroids, which, was, President Monroe, he said, I think he basically said anything that happens in the Western Hemisphere.
Right. Our hemisphere. Yeah.
In our hemisphere, we are going to be involved and we are going to take an active role in it. Right. And so I could see, from the North Pole to the South Pole, all along the Americas, North America, Central America, and South America, kind of aligning in one big block. And if think about the world and what block could knock that block off, I think it'd be pretty tough to do.
Right. And it's also that block push Europe. And, I know Europe isn't as
Right.
strong as they used to be, but it's not even just the Western Hemisphere, right? Yeah.
Yeah.
Okay. So, super fascinating. One of the challenges with you, Brent, is so much to potentially talk about, so limited time.
We could do it all night.
I know. Well, look, if we can, we're almost at the hour. Maybe we'll go 5 minutes over, but I'll try to keep it concise. I do want to get to the so what, right? Which is, okay, so you've got this general up and to the right view of the world in terms of that's where asset prices go. That's where, if you're an American, which most of the viewers here are Americans, but certainly not all, your prospects are likely to go up and to the right as well. But neither of those are going to do that in a straight line. And so you want to protect yourselves from the times when the line's going down. And based upon what you talked about at the beginning of this interview, you said, look, I'm kind of worried in the immediate term at the valuation extremes that we're at. So much so that I'm now starting to take some action in my portfolio. So when you and I talk, you've got your assets that you've told me these are the assets I'm going to war with, and I'm really just kind of dialing up or dialing down my exposure to them. If I remember them correctly, it's blue chip U.S. equities for the most part, real estate, gold, and is number 4 T-bills?
Yeah.
Yeah.
That's right.
Okay.
Cash or T-bills, but yeah, might as well get paid to hold your cash.
Okay. So, A, is that what you're still in? Or are you adding anything else to the mix? And B, what are you doing, or what do you expect to do differently in the future, in the near term, given your immediate concerns?
Well, I'm reducing exposure to equities right now. I'm doing that via options. We're not selling the equities that we own, but via options, we're reducing exposure to
Okay. Meaning
equities, and
you're hedging, you're buying hedges.
we're hedging them. That's right.
Yeah.
I'm actually, I don't know if I'm going to, you think, you know, that I expect gold to pull back, but I would like to add more to gold. The thing is, if we don't add to gold, it's fine because we own enough. But I would like to own more because I think in the years ahead, gold is going to play an increasingly important role in a portfolio. So I would like to add some of that, but I probably not going to get that opportunity until, you know, mid 2025. We'll have to wait and see.
Because you would only add on a pullback,
Yeah, I mean,
on a material
like
pullback.
yeah, I would only add, and even if we don't add, it's not a big deal because we already own enough
Right.
of it. But I would like to add. The other thing that I'm really kind of focused on because I think, you know, I don't want to invest overseas right now. I want to invest mainly in the U.S. And again, we mainly do it in large blue chip U.S. equities. But I feel like there's probably some more focused areas that we could do some stuff. And to be honest, I'm a little frustrated because I haven't found it yet. One of the areas that I do think uranium in the years ahead is going to be a big one.
Funny, I was thinking
You know,
nuclear as you were saying that.
it went up a lot. It's pulled back, and then it went up again, and it's kind of been all over the place. But that's an area we own a little bit, but we don't own enough, and so that's an area that if I had to pick an area that I don't have enough exposure to right now, that would be it.
Okay, and I got to ask this question because I'm sure the folks in the comments will shoot me if I don't. Brent, what about Bitcoin? Dude, it's the best performing asset of our
Yeah,
lifetime.
listen, I'm going to say what I'm going to say what I always say about Bitcoin. I love it philosophically. I just don't think it's the one all be all that many of my friends and, you know, other people I interact with think it is. I don't have anything against it. I just think that I think it's the most speculative asset in history. I think it's the purest play on global liquidity that there is. And when liquidity disappears, I think profits in Bitcoin will disappear. Now, that doesn't mean Bitcoin's going to disappear. I don't think it's going away. But, you know, I own a very, very, very small amount of it. I've helped clients buy it. A lot of my clients own it. So I'm not against it. I just don't think that it should be your entire portfolio. And I don't think that it's guaranteed to win the way that many other people that are in the space think that it is.
Okay, I mean, you clearly don't think it's a go to war with asset because it's not in your go to war with top
Yeah.
four. Yeah.
Yeah.
Okay.
I mean, maybe a small piece of it, but yeah.
Yeah. Okay. All right. Well, look, lots of other questions. We'll just have to save them for next time. Brent, for folks that have really enjoyed this discussion, would like to follow you and your work between now and the next time you're on this channel, where should they go?
Well, a couple different places. You know, I do a weekly show on YouTube. It's called Milkshakes, Markets, and Madness. I hope you can check that out. We typically just talk about what's going on in the world, what I see that's interesting, and every now and then we'll go over, you know, a concept or some kind of an analysis that I like to do. About 6 months ago, a friend of mine and I started the Macro Alchemist. And if you go to macroalchemist.com, you can sign up. I'll actually announce it now if you don't mind. We've been giving it away for the last 6 months for free, and through the end of the month, you're going to be able to access that site and get everything, download it for free. But starting in the new year, it is going to go behind a paywall. And we have a special opportunity for the first 100 people that sign up. There's a pretty significant discount. So if you go to macroalchemist.com, and if you like some of the research that we've been putting out and you want to be part of it going forward, starting January 1st, it will be behind a paywall.
Okay, and then you're pretty active on X.
Oh yeah,
Carry handle.
Yeah, probably too active on X. Santiago AU Fund.
All right. So Brent, when I edit this, I will put up links to all those, your podcast,
Okay, great.
your new website for macro analysis, and your X handle. Folks, the links will also be in the description below this video too, if you just want to get there with one click. You were very kind to share a very deep dive report that you and your colleague there wrote on the yen carry trade with my premium Substack subscribers as part of Macro Pass last week. Brent, I just want to let you know I got rave reviews from those
Oh,
folks
great.
about it. So yeah, just know that people are really liking what you're serving there. Okay, stay with me 1 second, Brent, because I want to give you the chance to have the last word. I just have a little bit of quick housekeeping. So folks, if you really enjoyed having Brent on the program here, would like to have him come back on the channel again early in 2025, whenever his outlook on the future is changing in any material way, please encourage him to do that by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Now, if you're looking for help in trying to position for what may lie ahead in the future, especially if Brent's outlook, over the coming months and next year prove to be prescient, highly recommend that most folks do that under the guidance of a good professional financial advisor, and especially one that takes into account and understands all the macro issues that Brent talked about here. If you've got a good one who's doing that for you, great, stick with them. But if not, or you just like a second opinion from one who meets those criteria, then consider scheduling a free consultation with the financial advisors endorsed by Thoughtful Money. These are the financial advisory firms you see with me on this channel week after week. To schedule one of those free consultations, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple seconds. These consultations are totally free. They'll review your whole portfolio and personal situation, your goals, your risk tolerance. They'll tell you what they think you should do. You can do whatever you want with that information. You can deploy it yourself as a DIY investor. You can bring it to your existing financial advisor, or you can continue talking with these guys. There's no strings attached. It's just a free public service they offer to try to be as helpful to as many regular investors like you as they can. I also want to note too, these investors are very familiar with how to set up hedges as a defensive, insurance in your portfolio in the way that sounds like Brent is doing there at his own firm. And if you go to thoughtfulmoney.com/hedging, you'll see a tutorial that one of the firms put together, kind of explaining the most common uses of options as a downside hedge. So if this is all new to you, that's a really good way to kind of learn the terminology. All right, Brent, thanks for being. Oh, sorry, last. When you're there at thoughtfulmoney.com, don't forget to hit the newsletter link at the top of the page to sign up for our free newsletter. And I just want to remind folks, if you're thinking of considering upgrading to the premium version of the newsletter, and that's where you get all my Adams Notes summaries of all these videos, the Macro Pass service that I just mentioned, plus a whole host of other benefits. The price is going up at the end of this month. So if you've been thinking about upgrading, upgrade now, because everybody who upgrades now will get grandfathered into the current price of $15 a month, $150 a year. It's going to go up to $19 a month, $190 a year on January 1st. So if you sign up now, you'll get grandfathered into that lower price, and you'll keep that lower price for as long as you remain a subscriber. And that's true for all the existing premium subscribers. If you're one of the folks who signed up last year, I think it was like $8 a month, you're going to keep paying that low price for as long as you remain a subscriber. So I want to help as many people get as grandfathered in as possible. All right, Brent, thanks so much for your patience. Folks watching this video are just regular investors, right? They're folks that have goals, dreams. Mostly they want to preserve the wealth they have, but they'd like to prudently grow it as well, even in an uncertain future. Most importantly, they don't want to lose it all, by being poorly positioned if there is a big market downturn. Any parting bits of advice for those people?
No, I think the best thing to do is keep an open mind. Don't, I think one thing that's popular is you find somebody who's been right for 6 months, and then that's your new guru. And then he's wrong and somebody else is right for 6 months, and you jump over to them, and then that's your new guru. I would encourage people to listen to as many different people as you can. Be really honest with yourself about what you're good at and what you're not good at. And if you're just not good at managing your portfolio, find somebody that can help you with it. And maybe you don't have to have them help you with all of it, but maybe even just helping you with a portion of it will kind of help keep things on the right track.
I couldn't agree more. You know, so much of life is leaning into your strengths and trying to find ways to complement your weakness, right? Like bringing in the pros for the things that you're not great at.
Yep.
And I've been very transparent. I don't manage my own portfolio. I'm too busy running the business of thoughtful money, where, you know, obviously I'll interact with them and I'll certainly share my goals and what I'm trying to do. But they're the professionals at doing the allocations, doing the position sizing, doing the harvesting, right? That's just stuff, honestly, I'm not very good at because my attention is focused on other things. And most people are like that. They've got jobs, they've got families. Some people don't have the background to understand this stuff. Some people don't have the interest of doing this, right? So I think unless you really are, you know, proven yourself to be kind of a skilled DIY person with a pretty good track record, then be honest with yourself in the way that you're mentioning. Also, to your point too about kind of performance chasing, that's something that a lot of retail people fall into, and it's a trap because you've got math working against you here. Usually, people outperform, right? Like we all know the stat, right? That like the majority of capital managers underperform the S&P on any given year, right? So what people do is they look at, well, who outperformed last year? Oh, I'm going to go with that guy, right? Well, you're going after the guy who had his rare moment in the sun, and he's much more likely to revert to the mean, which means he's probably going to underperform in the following year. So, you know, that's one of those classic examples where human behavior just it works against our interests, right? Our emotions, our gut instincts actually are working against us. You're nodding as I'm saying all this.
Absolutely. No, that's exactly right. And again, you don't have to be honest with everybody else, but you got to be honest with yourself.
Yeah, absolutely. And it's your money. We don't want to screw around with it. All right. Well, look, Brent, such a joy. Thanks so much, buddy. And have a great holidays with your family, and really look forward to having you back on the program early next year.
All right. Same to you.
All right. Everybody else, thanks so much for watching.